Okay, great. In terms of expenses, the first line item we put down under revenue is the cost of goods sold. So remember we made the banana watches and it cost us $200 to make one, but we sold them for $300 a piece. So for this company, we have the cost of goods sold model out there as 10% gross margins. And so it makes sense early on in the life cycle of a company that it costs them much more money to produce one unit of their product than it does later on. And so revenue minus the cost of goods sold, remember it's equal to gross profit. And so gross profit divided by revenue is called gross margin, and it's expressed in a percent term. And so the gross margin for our company here that we're modeling is 10% in 2015. And it goes down to 60% or goes up to 60% in 2018. Higher is better because you're making more gross margin profit on that item. Now, we have to come up with the operating expenses as well, which is below gross profit. Okay, so we add our three generic titles or line items for operating expenses, and this is applicable to most companies. Okay, you add sales and marketing, that's S&M, general administrative, that's G&A, and then R&D, which is research and development. And almost all companies have these three line items. Pretty simple. Okay, great. So we're going to look at operating profit now, and so we're going to model it. And as you can see, I've put in these numbers. And you might ask yourself, Chris, how the heck did you come up with these numbers? Well, you can actually go to publicly traded companies that are similar to this company, okay? And you can look at what percent of revenue S&M is, or G&A, or R&D. And all this stuff is out there on the internet. The Securities and Exchange Commission mandates all companies put this stuff out there if they're publicly traded. And we'll cover that more later on when we analyze a publicly traded company and model a publicly traded company. Okay, so as you can see, we look at everything as a percent of revenue, and operating expenses here are just sales and marketing plus G&A plus R&D. Okay, great. So we did that all the way across, and so we make our assumptions. We assume that the company becomes more efficient over time. And so, as you can see by this graphic here, this Excel snapshot, I had sales and marketing at $500,000 in the first year. Then it spikes to $4 million in the next year. And that's actually less as a percent of revenue. Okay, so you'll see that sales and marketing is 25% of sales in year one. Then it goes down to 20% of sales, but it jumps to $4 million, but it's still only 20%. Then it goes to 19, then 17, yada, yada, yada. Okay, it gets less and less and less until eventually the company breaks even. Okay, it starts making money. So in this hypothetical model here, we have our company breaking even from an operating profit perspective in 2017. Okay. And again, just keep adding comments. Now we're going to do below the line items, which is an accounting nerd term for below operating profit numbers, like interest and tax. And remember we talked about how we're comparing our banana watch company in the past to the less successful Swiss watch companies, and how they have different tax rates and different interest rates, which is why we look at below the line numbers separately. Okay, so we threw in that number there, and again, just comment your Excel spreadsheet so that later on you can understand what you were thinking. Okay, so we don't really put in tax until year 3 because we weren't profitable until year 3. In fact, what you could do, and I'm not going to go into too much detail of tax accounting, but if you had a massive loss, say you lost $20 million in year 1 and year 2, you can carry that forward and you'll never pay taxes until you make up for that $20 million in losses. Okay, so that means that the first $20 million going forward, for example, in taxes you're supposed to pay, you're not paying them. They're carried forward. Those are called NOLs, or net operating losses. Okay, back to our model. So everything you've seen here is just a percent of sales. And again, when we analyze a publicly traded company, we're going to look at this in much more detail. Okay, I wanted to make this a very quick study for you. So I ask now, is the $350 million valuation that we paid from a venture capital perspective to invest in this company attractive or not? We invested in this company at a valuation of $350 million. So in order to answer that, we have to analyze the market and what competitors are trading at. And so right now, the stock market is paying 10 times revenue for growth investors. Okay, 10 times revenue. That's a little bit high. It'll come down over time. You'll see. And the stock market, for example, is paying 10 times EPS for value investors. And I don't think value investors are good at tech, but that's okay. They're just a different breed of investor. Okay, so let's assume an IPO now in 5 years. Okay, so our value investors, who I wrote here suck at tech, no disrespect to them, they pay 10 times earnings. Okay, so in 5 years, our earnings times 10 equals a valuation of $5 billion. Not bad, eh? We're making $500 million in earnings in 5 years. Okay. Now, our growth investors in 5 years or so, our growth investors are going to pay 10 times revenue. Now, our revenues eventually will be, it looks like 1.3 billion. So 10 times that is about 13 or 14 billion dollars, right? Which is pretty good. So we're assuming an IPO in 2020. And when I say that value investors suck at tech, I don't mean that they're bad investors when it comes to tech, but you can never buy a tech stock because the stock is cheap. Okay. When a tech stock is cheap, it's because no one wants to buy it, right? Remember, the best investors in tech value companies based on earnings 5 years from now. And it reminds me of something. Warren Buffett came and guest lectured at one of my classes at Columbia years ago, and it was a real treat for us. And one of my colleagues, this is back in 1999, one of my classmates was pitching a tech stock to him in front of 150 students. And Warren Buffett listened politely for 30 seconds. And then he very politely interrupted my classmate and said, "Son, I'm going to stop you right there because I'm not going to invest in a technology company because I don't understand where these companies are going to be product cycle-wise 3, 5, 7 years from now. When I invest in a company like Coca-Cola, I know the Coca-Cola beverage is not going to change that much. And so I can understand it longer term. And so you never invest in something you can't really understand longer term." And he was brilliant because a couple of months after that, I think he came in November of 99 to present at school. By March of 2000, the market crashed. Tech stocks went down a lot. And so he was quite brilliant. So value investors they just don't like to invest in tech companies because they're expensive. And that's cool, man. I'm a growth investor. I don't know what you are yet. You might not know for quite some time. But people are usually growth or value on that spectrum. And if you're stuck in the middle, then that's called GARP, or growth at a reasonable price. And so venture capital investors and tech investors are growth investors. And people that like to buy stuff that's cheap, meaning outside of tech, are value investors. And all great companies in technology go from growth, and then when they mature, remember the last stage? Remember the red bar with a shark? When large companies or tech companies, when growth slows and they mature, they transition from growth slowly to value. And that transition, when these companies are big and mature, takes at least 10 years. And that's purgatory from an investing perspective. Why? Because growth investors won't touch the stock because it's not growing fast enough. And value investors won't touch the stock because it's not cheap enough. And so I remember when I worked at Citadel, I pitched Microsoft this long idea a decade ago. And my boss at the time told me, and he was right. He said, "Chris, in all my years of investing, I've learned don't ever invest in a company that hasn't moved in like 5 years or so, or that's not growth and not value, it's stuck in the middle. Because who's the incremental buyer? There are no incremental buyers for quite a while." Okay, I digress. Back to our model. Okay, so our growth investors believe that this company we just created a model for is going to be valued at close to $14 billion in 5 years when we go public. Okay, and our value investors who value based on earnings are paying 10 times earnings in 5 years. So in 2020, roughly at that point in time, the company will be valued at $5 billion or 10 times $500 million in earnings. Okay, great. So that's awesome. That's awesome. So that means that our $350 million valuation on this company we invested in is a freaking home run, man. Right? So even if you take the valuation target that you had, the price target, and you discount it by 25% to be conservative, you're still making a ton of money. It's more than a 10-bagger. So our $350 million valuation on this hypothetical investment was great. And we're going to do well in this investment because we invested in a great management team, the jockey is more important than the horse. This person has been successful in the past selling companies he started. So the probability of you being successful backing this jockey is much higher. Okay, great. So how do we value this company? And so this company is a little bit like Salesforce. There's a software cloud component to it. Salesforce, for those of you that don't know it, is the largest employer in San Francisco now. It's a big cloud software company. Okay, so we can see if you look at the bottom here, or the second line from the bottom on the Salesforce valuation analysis, Salesforce is trading at 9 times. Okay, 9 times revenue. Okay, remember we valued our company at 10 times revenue and then took a 25% haircut? And our company is growing much faster than Salesforce is. Okay, so again, our valuation at $350 million in this company is a darn, it's a steal. It's a steal. Okay, so it's a great investment. And again, it all came down to backing the right jockey. Okay, notice how I'm not really talking about what the company does. That's on purpose. Okay, invest in the right management team first. Business model is always secondary. Anyway, you'll see. I learned the hard way early in my career when I was a public market investor. I remember I bought this company that was a software company. I'm not going to tell you which one it was. It's very embarrassing. But it was dirt cheap. And they had the worst management team on the planet. And I lost money on it. And I learned my lesson then. I'll never invest in a company. I don't care how cheap it is. I don't care how awesome the business model is. I'll never invest in a company that doesn't have a kick-ass management team. Okay, great. So look at that. We got 40% growth there, revenue growth in 2020. Right? So 2020, we've got $1.399 billion in revenue forecast, right? If we throw a 10 multiple on that, that's a $14 billion value company. So growth investors will value based on revenue multiples. So 10 times revenue in this hypothetical example is $14 billion. Okay, and even if you haircut that a lot, it's still a bargain compared to our $350 million investment valuation. And the bottom line there is net income. Okay, I've cut off the titles there. I'm sorry. And so in 2020, we're going to have net income that is very, very high, right? So anyway, actually, I digress. I'm sorry about that. The bottom line there is gross profit. Net income was closer to $500 million, which is way, way below that. Okay, so what is the sustainable growth rate in 2020 when this company goes public? And we'll talk about the whole IPO process very soon. Okay, it's fascinating. So how fast can this company physically grow before hitting a wall? Well, you can quantify that. So the sustainable growth is basically what is the maximum growth rate a company can achieve without getting additional financing from equity firms or debt firms. Okay, and the formula is pretty simple. It's ending equity minus beginning equity divided by beginning equity. That's the sustainable growth. And so retained earnings is part of equity, which is how much profits we've derived over the years. So let's check out our sustainable growth rate in 2020, which is the year of our IPO. We're not going to assume we have dividends. Okay? It's a tech stock. Tech companies that go public don't issue dividends, usually within the first decade of being public. Okay. All right, so the beginning equity value we had for our company was $350 million. The ending equity value of that year is $860 million. The difference there is called retained earnings. And what you do is you take net income and you add it to your beginning equity value, and that becomes your ending equity value. Okay, so here we've got the most we can grow in 2020 is 145%. Let's make sure we're below this metric. And so let's take a look. So if we look at our spreadsheet, our 2020 growth rate is actually 98%. So we're growing at a rate below our sustainable growth rate. All good. Now, if we were growing above the sustainable growth rate, we would need to raise money in order to feed our growth. Okay. So again, our sustainable growth rate, the maximum we can grow before raising more money is 145%. And we're currently at 98%. Okay. But if an activist investor like Carl Icahn, for example, pressures us to issue a dividend of say 40%, then we simply multiply the sustainable growth rate by 1 minus the dividend rate. So that would mean 87%, right? So the max we could grow if we had a 40% dividend is 87%. Okay. So sustainable growth rate equals net income divided by beginning equity times the retention rate. and the retention rate is 1 minus the dividend. Okay. So let's manipulate that last formula a little bit. And let's have some fun with math so we can better kind of understand how to manipulate our financials to meet our sustainable growth targets. Okay, so here we go. And if this is a little bit over your head right now and you're not passionate about math, don't worry about it. Just skip over this section. But I'll try and go through fast. Net income divided by equity equals return on equity. Remember, whenever you have a return on something, it basically means net income or profits divided by whatever that return on thing was. So return on equity is net income over equity. Okay, and so net income, we're just moving that formula around. Net income divided by equity is equal to return on equity. Return on equity equals net income over earnings. Return on equity equals net income over net income over equity times 1 times 1. Hold on a second. Okay, and I put that times 1 there because it's equal to net income over equity times sales over sales times asset over assets. And you manipulate those, and it's just math, okay? And then what you can do is find out that growth is a function of those three formulas, okay? And so, therefore, growth is equal to net profit margin, which is net income over sales, times the asset turnover rate, which is sales over assets, times the equity multiplier, which is assets over equity. A lot of math, I know. But I only mention this because I can increase my sustainable growth rate using one of those three equations, right? So let's increase our net income or our profit margin, which is net income over sales. Okay. So right now we see that our net income is growing 98% year over year. How do we make that look better? Okay, and this is important. This is called leverage. Okay. So we can see that sales and marketing as a percentage of revenue in 2020 is 14%, right? If we tweak that, or it was 15%, now it's 14%. If we brought it from 15% down to 14%, then you'll see that our year-over-year growth rate in earnings increases from 98% to 115%. That's called leverage, and it's a beautiful thing. It's a beautiful thing. Okay, we covered a lot today. Okay, and I know some of it might sound a bit confusing, but it's going to get much easier because we're going to do a much easier example later with a publicly traded company. I'm getting excited because soon our company is going public. I'm excited. Okay, so here's a quick class recap, my 140-character less is more summary. Longer-term forecasts are annual estimates. Percentage of sales is the most important part of financial modeling. Expenses are really easy to tweak. Spend most of your time forecasting revenue. Everything else is a percent of revenue. Thank you.